Okay, so today lecture is about the risk and return. The agenda of today's lecture is what is risk and what is the return. In past, this was one of the most important topic to study on the basis of different markets. Like you have studied a theory that is called EMH theory, efficient market hypothesis theory, where you studied different type of markets like the strong market, the weak market, and the semi-strong market. So this was the past. Okay, no doubt this theory is still very much in action everywhere in the world. But if you compare the current era of COVID-19, so you can easily say that what is happening in the world, irrespective of EMH theory, irrespective of any theory, there is some uncertain situation because of this COVID-19 that hit hardly every corner of the world, every economy of the world, every market of the world, irrespective of strong, semi-strong, or weak market. So the planning of the business gurus, the planning of the academic gurus, the planning of the industries gurus, the planning of the stock markets gurus is no more in front of COVID-19 because this had hit hardly and still you don't know what will be happening in future. A lot of impact in the whole world has been done and a lot of damages has been done because of this COVID-19. A lot of research papers being developed, being written on this COVID-19 because before 2019, you even cannot imagine such a type of risk to the market. You cannot had any plan before this. This was a certain, a natural, either built biologically or it is a natural. You cannot say anything because this is also ambiguous. But the fact remains that COVID-19 is a challenge for every economist, for every economy, for every financial experts, for the EMH theory by itself, for every risk and for every return. You are not sure about your risk and return as it was in past, but in past, these economists developed different type of theories in order to minimize the risk. But this COVID has just abolished the concepts of the risk and return. However, what is happening in the world that this COVID-19 is a curse for one corner of the world, while it is a blessing for some industries as well. Like you can take the example of medicine industry, like the pharmaceutical industry, like the hospital services industry, like the gas that is CO2s or gas industry. You can have all these industry in a boom. Why? Because this is a blessing for them in such a type of situations, in COVID situations. However, a lot of industries have been damaged and a lot of businesses been shut down because of this COVID-19. In past, if you analyze the literature, there was a time that was called 1998, 1988 financial slumps that was called a bubble up economy. Slowly and gradually, after some time, it was a bit controlled. But later, what happened? This bubble up economy again hit the world in 1998 after 10 years. Then in 2008, once again after 10 years, this economy again hit the world very strongly, like the markets in Dubai, Singapore, and developed country financial markets being collapsed. In 2018, like the sequence was continued from 1988, 1998, 2008, and 2018, it was due that the world will be hit by a financial crisis. But who knows, in 2019, the world been hit by COVID-19, which was not even in the imagination of the developed, developing, underdeveloped, or any weak economy. Why? Because irrespective of any economy, what happened? It hardly hit all the world. So, coming into nutshell, today we are studying about the risk and return. And risk and return, you have to go for 3 to 4 theories. The first theory is the EMH theory. The second theory is the agency theory. The third theory is the capital assets pricing model theory. The fourth theory is the market macrostructure theory. So you should be aware about all these theories, then we will go for it. No doubt, everyone knows the definition of risk, that what is risk. Like you can take the example of cricketer Shoaib Akhtar. About the Shoaib Akhtar, it was said that the maximum risk, the maximum return. If you take risk against him, if even you just hit the ball, you can get a 6 as well. But if you miss, you will hit the wicket of yourself. Risk is like that. It is not known whether the risk will be positive or negative, because risk by itself, people consider this risk as a negative. But in risk, a lot of people, because of taking this risk, they got a lot of returns as well. However, the concept of this chapter is in the shape of what? In the shape of how you will minimize the risk, because you cannot abolish the risk. How you will minimize the risk, and after minimization, how you can get the maximum return. So in this chapter, we are just talking about a market, either it is stock exchange market or any other financial markets, or you are just talking about the general businesses. You have to take the risk, and risk doesn't mean a negative risk. Risk can be a calculated risk as well. I'm not talking about the COVID-19 now. I'm just talking about the real concept of the world, that you can take a calculated risk which can give you the maximum return. And if you took a calculated risk as well and you don't know about the hit of COVID-19, then this calculated risk, this measurement of risk will not work for you. So there are some concepts of controllable and uncontrollable risk as well. Like this COVID-19 is an uncontrollable risk. You cannot control it. You cannot make a plan for it. It will hit the economy. It will hit your return, like it is hitting the return of every market. And for sure, this will have a long-term effect when it will comes to an end, because the world is still not realizing its economic effect. Still the people are realizing the death casualties, the health effect of this. But when it will comes to an end, a lot of effect of this COVID-19 will be on international markets, on your local markets, on international products, on your local product, on the banking industry, and the foreign industry, everywhere it will be spread like a virus in the shape of economy flaws. So let's come to the risk and return chapter. In this chapter, what we have to do after studying this chapter, you will be understand the relationship between trade-off, that is between the risk and return. What will be the definition of the risk and return? How you will discuss the different types of investor attitude toward the risk, how to explain risk and return in a portfolio context and distinguish between individuality, security, and portfolio risk, then distinguish between avoidable, unsystematic risk and unavoidable systematic risk, that is like a COVID-19, and explain how proper diversification can eliminate one of these risks. One of these risks means you can only diversify the unsystematic risk. Then define and explain the capital asset pricing model, one of the very, very important model, but in my personal opinion cannot be implemented to Pakistani market. Then you have to calculate the returns, then the demonstrations, and then the explanation of the efficient financial market based on the efficient market hypothesis theory. So I'm audible to everyone, please?
Yes, sir.
Yes, sir.
Yes, sir.
Okay,
Yes, sir.
okay. Okay, so coming to risk and return, just if you think about the risk, if you think about the probability distribution, if you think about the attitude toward works, if you think about the risk and return portfolio context, if you think about the diversification, if you think about the capital assets pricing model and efficient market hypothesis theory, one thing should come in your mind, that is called a market. All these things will be happen in a market, and a market is a place of buyer and seller, where buyer and seller meets. So why a buyer and seller meets? Obviously for return. So with every return there is a risk tied up. Like you can assume any type of return, there is a risk, and risk can be either positive or negative, because a risk is just like a coin tossed in the air. You just tossed a coin in the air and you don't know about the return, whether it will be head or tail. So in order to make this head or tail, you cannot do anything. In the situation, such a type of situations, if you are investing in different type of market, then it means you have tossed the coin in the air. Here, one thing is for sure, that you are basically playing with risk for the return. You're playing with a risk for the return. So why this risk you want to take? Only and only the reason is the maximum return. This is basically a return. So being a economist, being a student, being a researcher, you should know what type of risk I will take and where I will take the risk in order to get the maximum return. So it belongs to you. You have to do the market survey, because market, like stock exchange, is full of, I think 1,000 companies are over there, out of which 450 companies are functional. So there are different type of sectors. You can have agriculture sector, you can have cement sector, you can have oil and gas sector, every sector. So you being a student or a researcher, you should know the market. Then in market, a lot of companies, a lot of sectors are over there. Then you should know the sectors as well. Which type of sectors I will go for investments? Why you are going for investments? In order to get the return. So for this return, you have to think for the risk. And in simple words, there's a lot of investments, like you can invest in the stocks. You can invest in the debentures, you can invest in the commercial papers, you can invest into different businesses, like for direct, like you can invest in the projects as well. You can invest in the service industry as well. You can invest in the production industry as well. You can invest in the finished goods direct sale industry as well. It's up to you where you will invest. You have to keep an eye on the overall market, and for this keeping eye on the overall market, you have to know about the efficient market hypothesis theory. Efficient market hypothesis theory will tell you about the different market. Either you are in a well-developed strong market, or you are in a semi-strong market, or in a weak market. So the nature of the market will also impact the return and risk as well. If you are investing in a very strong market, irrespective of a weak market, what will be happen? Your return will be different. So on the basis of this return, you have to utilize the EMH theory, efficient market hypothesis theory, which will tell you about the different type of market, the nature of the market, the businesses of the market, their return from time to time, and their consistent return. Their data will be not in a very zigzag mode. Their return will not be in a very zigzag mode. There will be a smooth flow of the return in a strong market I'm talking about. But if you are talking about the weak market, then the return will be in a zigzag. You are not sure whether you will get a lot or whether you will get less. So you are just throwing your investment over there. However, keeping one point in mind, that what is most important thing for you is the assessment, is the analysis, is the problem, that what is the actual problem in the market. Because you are working for return and you want to minimize the risk. For minimization of the risk, you should know the problem of the market, the issues of the market. Before return, before taking the risk, you should know the market. Whether you are in a Dubai market, or you are in Afghanistan market, or in Pakistan market, or in Bangladeshi market, or in US market, you should know the market. Because this nature of the market will tell you about the consistent return of different companies. So in stock exchange, you can go and you can invest on daily basis as well. You can purchase on daily basis, you can sell on daily basis. You can even hold it for so many time, for up to you, whenever you want. So it's up to you. But the stock exchange of that country, means the country where the stock exchange is very much important. Like for example, I can give you the example of current Pakistani market, stock exchange market. Like when Chinese government allowed Cell company to prepare the COVID vaccine, this was a very positive intent, and this gave a very positive effect on the stock exchange. Similarly, well, Indian Prime Minister wrote a letter to Pakistani Prime Minister Imran Khan about his health when he was hit by COVID. This was another very positive thing that hit hardly the stock markets. Similarly, there was another thing yes, when the finance minister just conferenced and said that we will start business with the India very soon. That is another border positive thing. Similarly, if these are the something that will affect the market, either this is very small thing, but it is affecting the market. In return, if you have a negative things, then obviously, like for example, Shaheed Muhtarama Benazir Bhutto, when she was assassinated in Rawalpindi, your stock market was stuck. When Prime Minister, I think so, Gilani was removed by Supreme Court, the stock exchange went to stuck. Why? Because it is hitting the political instability of any government. Whenever you will measure the market, you have to also think about the macro structure theory as well. What is macro structure theory? Macro structure theory will tell you about the inflation of the current market where you are going to invest. They will tell you about the poverty condition of that country. They will tell you about the GDP of that country. They will tell you about the GNP of that country. They will tell you about the deficits of that country. They will tell you about the import of that country. They will tell you about the export, and they will tell you so many like debt financing, equity financing of that countries as well. So in a nutshell, what does this mean? That if you think is a researcher, so for a researcher, you need the data. Then on the basis of data, you will take the risk. And then the data will give you the accurate results of the return. If the previous data of the market on the basis of return is not according to the expectation of the investors, so what will be happen? Obviously, the graph of the return will be zigzag. Either it will be downward. So when it will be a downward graph, it means that the market is not going well. In turn, you can say if the graph is going up on the basis of the previous data, you are thinking that the market is very positively behaving, and what will be happen? Obviously, if you invest in the market, so there will be a minimum risk. However, according to Warren Buffett, he invests in such a type of markets where there's a lot of risk, but he also earns from that market. This is something very much like against the theory, he said, but he is one of the big name in the financial industry, in the finance, in the investment industry, Warren Buffett. He is a big name, but he said, I also invested in those markets where there's a lot of risk involved, but I still earn over there. So to cut it short, today we are in the chapter of risk and return. Risk should be taken, but before taking the risk, you have to keep the two theories in mind: the EMH theory, efficient market hypothesis theory. The efficient market hypothesis theory will tell you about the strong market, semi-strong market, or weak market. In return, you have also a theory that should be in the shape of macroeconomic theory, like you should know the GNP, the GDP, the inflation rates, the unemployment rate, the current deficit, the fiscal deficit, the monetary policies of that country, the interest rates of that country, the development of that country. You should know all these things as well, where you are going to invest. The third, that is another very important theory that should be used in this chapter, that is assets pricing model theory, that is capital assets pricing model theory, where you will think about, or where you will think that a specific percentage should be a risk-free, rest I will earn from the market. So I'm audible to everyone, please?
Yes, sir.
Yes, sir. Loud and clear, sir.
Okay, that's great. So defining the risk, so simple. Defining return, income received on an investment plus any change in market price, usually expressed as a percentage of the beginning market price of the investment. So income received, this income received is your return, like the red is your return. And the other thing is change in price. So this is very devastating. This change in price is directly linked with the theory, the market, with the macroeconomic variables, with the conditions, with the risk you have taken. By assuming that you have minimized the risk, this change in market price is very much, because this market price change can either be positive or can be negative. Like what you do, if you see the formula, in formula, you did what you did, Dividend, like income received, that is on the investment, plus means the dividend. You cannot get the dividend always. So the plus current minus previous price. If there is a positive variation, so dividend will be so it will be added to the dividend. If there is negative, then obviously and market is doing behaving like this. Even if you think about the behavior finance, in behavior finance there is a different type of other impact, like Ramadan impact is over there, like Friday impact is over there, like Monday impact is over there, like Shab Barat impact is over there. So these the other religious festivals that is like celebrated, that has a big impact. Even Muharram has a big impact on the stock exchange, because there is a off in the Muharram, there is off in different other activities as well. So all these activities should be kept in mind while setting your investment. So return is basically income received plus change in the market price. So this change, this is basically the change, the current minus the previous price. So this is a simple definition. So return example, like for example, they give an example, the stock price for stock A was 10 per share 1 year ago. The stock is currently trading at 9. Look at this, it was on 10 and currently it is at 9.5 per share, and shareholder just received a dividend. So why he is saved over here? He is saved on the basis of the dividend, because what happened, the current price is less than the previous price, but he is saved on the basis of dividend. So look at over here, like what he did, he got a dividend, and dividend make him save. Like in 10 he lost 0.50% over there, but he got $1 is a dividend. That is why 50% has been earned. Like this, if the dividend was not offered to him, so he lost, the loss was 5%. So his return is only 5%. In this regard, if for example the current trading value will be like for example 12 or 13, so the return will be different. It will be a big return for the investor. That is why return is very much important over here. Similarly, defining the risk, let's define the risk. We define the return. Return is the dividend plus any change in the current price from the previous price. Then we have to add it to the dividend, and then we will do it. But the slides don't only think for the slides, think very broadly. This playing of dividend and risk and returns are in a market. Assume you are working in a market where there you have to face the return, you have to face the risk, you have to face the dividend, you have to face the depreciations of the price, you have to face the appreciations of the price, because risk is the variability of the returns from those that are expected. Very important. Expectation. Okay, you are expecting something, and in return you get other thing doesn't mean you will get negative. You can get positive as well. Like expectation, something, sometime you just drive on a highway or a motorway, and you went on a very high speed. Although this is a risk, but you reach on time and you say, oh, I just got on time, but I took a lot of risk. Sometime what happened, God forbid, if your car got stuck somewhere, or if, for example, if there is any mechanical fault, so you took the risk, and that risk just give the expectation, you expecting you will reach, but you did not reach. So the variability of return. So here the point variability, keep this point variability in your mind. This is basically volatility. This is basically tied up with the market. This variability is not because of the stock. This variability is because of the market market behavior. How the market will behave, there will be a variability, and variability can be in positive and can be negative. There is a positive variability and can be a negative variability as well. So what rate of return do you expect on your investments this year? This is a question. What rate you will actually earn? Does it matter if it is a bank, CD, or a share of stock? So basically, these are the points that what basically you are thinking. Like for example, you are expecting that I will get 15% at the end of the year. Obviously, you can get 15%. But how about the inflation, about the nominal inflation, about the real inflation? What will be the calculation? Like for example, you are thinking you will get 15% at the end of the year, and suddenly there is 12% inflation came in that country. So you earn only 2%, not 15%. This is not according to your expectation. So your expectation did not meet. So what happened over here? The risk will be increased. The variability will be negative. The variability will be negative, and it will give birth to the negative returns. And the negative returns was also expected. But whenever you are going to invest, you are always investing in a very positive mode. So what happened at the end, that what you thought, what you get, there is a difference between these two. So this is called a risk. In order to minimize this risk, you have to work on such a type of portfolio where the risk will be minimized. Here is an example. That is, I'm audible to everyone, please.
Yes, sir.
Yes, sir.
Other?
Yes, sir.
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 Okay, okay. So this is a simple formula. Like R is the expected return, R is the return for the I possibility, P is the probability of that. Probability, very important. Probability, you don't know about the probability is an assumptions. It is like a hypothesis. It is something you are assuming. And assumption is leading to the risk. Assumption is leading to the risk, and risk can either maximize your return or can affect your return, because you don't know about the market behavior. That is why this is a discrete discussions about the determining the expected return. What is this? This is basically an average. Like this is like you studied about the arithmetic mean in past. So this is generally an arithmetic mean. Like what they did, they took the summation of the expected return and multiply it with the probability. So how they did it, like we can see this example. There are different type of stocks. Okay, so these different type of stock, expected return and standard deviations should be there. I discussed with you people about the measure of central tendency and measure of dispersion. Did you know about the measure of central tendency and measure of dispersion? Hello?
सर मेजर ऑफ सेंट्रल टेंडेंसीज आपका मीन वगैरह होते हैं.
Yes, very good. Mean and standard deviations. What is the role of this? No, standard deviation is the measure of dispersion. Mean is the measure of central tendency. Mean, median, mode, quartile, decile, percentile, geometric mean, harmonic mean, all these are the measure of central tendency. Okay, and your standard deviation, variance and covariance, these are the measure of dispersion. So do you have the concepts of central tendency and dispersions as well? What is the concepts of measure of central? Do you know?
सर इसमें बेसिकली आई थिंक इसमें हम लोग यही चेक करते हैं कि मीन से आपका रिजल्ट कितना दूर है, मतलब
That's
एक्चुअल
great.
रिजल्ट क्या थे और आपके कितने हैं।
Yes, that's great. Anyone else, please? Hello? Anyone else, please?
सर मीन वैल्यू से हम कितना डेविएट कर रहे हैं, एक हमारा एस्टिमेटेड होता है और फिर जो एक्चुअल आफ्टर रिस्क और वो करने के बाद जो चीज आती है रिजल्ट हमारे पास कि हम अपनी मीन वैल्यू से कितना दूर हैं.
That is good. Very good. Well done. Okay. Central tendency. Central tendency is, it is appeared by its name. If you draw a circle and you put your pen in the center and there is a mark, that is called a central tendency. So every person, every organizations, either that is a production industry, either that is an investment industry, either that is like a selling industry, they should work on the measure of central tendency. There should be an average for every day or for every year or for a quarters, that averagely we have to sell these products. Okay, so for average what they do, they use either median or mean, but maximum researcher use the mean, and minimum and maximum. For measure of central tendency, the researcher are using the mean. Why? Because they want to know the average sale or average production or average profit, either for the days or for the weekends or for the quarters or for the years or for the half years and so on. They have, like every person have to make an average. Like for example, being a student, when you are doing your preparation for the studies, at the last hours you make the averages. I will study first 2 chapter up till 7 o'clock. Then if you did not study this and you studied only 1 chapter irrespective of 2 chapters, so the difference, you are far away from other chapter. This difference is a dispersion. You are dispersed from your own goal. That is why, what does this mean? That every organizations make the averages, sale, productions or supply to the other organization in the shape of averages. If there is any variations in the averages, so what happens? Variation means if the standard deviation is greater, then obviously it means that you are far away from your average, far away from your target, far away from what you set. But if the standard deviation is near to the central tendency, to the average you set, it means that you are near to your target. But this was the previous discussion and you know this, and we also discussed this. Here you will think this in the shape of the research, that how this, why this arithmetic mean will be set, why this standard deviation will be, and how, what is the reason why this standard deviation is far away from the averages. This is only because of the market you selected. This is the only because of the product you invested. This is the only because of the behavior of the market. Okay, like why you are studying this chapter? You are studying this chapter only to minimize the risk and maximize the return. So we are also discussing the measure of central tendency and measure of dispersion. If you are not according to the target, it means that you are not near to your mean. It means that your standard deviation is far away from your targets. And all these discussion is directly linked with the market where you invested, because if your standard deviation is high, then you are away from your target. It simply means the market you invested is not behaving according to the expectation or according to the target you set. So coming in a nutshell, you have to select such a type of market which will fulfill the expectation of your averages. You set the averages. So setting the averages, fulfilling the expectation, minimizing the standard deviations, all these things is wholly and solely depend upon the product you invested, depend upon the market you invested, depend upon the EMH theory, depend upon the macro structure theory, depend upon the assets pricing theory. So you are getting me, please?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Okay. So this is a simple thing like R and P. P is the probability, R is simple. So these are the different stock BW. What they did, the expected return for stock BW is 9%. Simply the going to the standard deviations we discussed. This is standard deviation is a risk measure. Okay. This is the formula of standard deviation, and you have studied this formula for so many times. But keep this point in mind that this is a risk measure. Risk measure means that it will tell you the average distance what you set for getting the average or for getting the target. If it is very high, the value of standard deviation is high, it means that the statistical measurement shows a lot of variability from the distribution or from the distance of the mean. Like standard deviation is a statistical measure of the variability of a distribution around its mean. What is mean? Mean is arithmetic mean. So mean is basically the average. Mean is basically the target you have set. So the target you have set is basically, if standard deviation is greater, then obviously the target you have set is not according to the your expectation. And if standard deviation is distributed in such a way where it's very near or around the mean, it means the target, the expectation, and the return you have set in advance is up to the mark, and you will get a good return. So what we are discussing about the risk and return. We are discussing about the risk, that the maximum risk will bring you the maximum return. But similarly, you should be very much aware about some theories, about the theory of macro structure theory, about the theory of efficient market hypothesis theory. Both these theories will be in a connection of risk and return, and thus this theory will give birth to the averages and standard deviations, because this theory will tell you about the market, about the economy of the market, about the situation of that market, about the investment activities of that market, about the stakeholder interest of that market, about the return of that market. Then according to the information provided about that market, on the basis of these theory, you will set a measure, you will set a mean, you will set a target, and will invest in that market. If the target is not according to the according to the expectation, this means that your standard deviation will be higher. And if the target you have set that is according to the standard, according to the target you set, it means your standard deviation will be low. Now coming to the discussion, from where you will get the standard deviation, from where you will get the figures of the mean. If you remember, if you recall, you studied the statistics. In statistics, if you remember, there your mentor gave you different type of question to define the arithmetic mean and calculate the arithmetic mean from the following data. Did you remember this?
Yes, sir.
Okay, so there is a point that define arithmetic mean and calculate the arithmetic mean from the following data. So the data is the important thing. The data belongs to the market. The data is basically something where you will be interested, because previous data will decide about the behavior either on the basis of mean or on the basis of return or on the basis of standard deviations. So what basically this means, one point that should be kept in your mind, we are discussing about the arithmetic mean, we are discussing about the standard deviation. So if you recall your previous lectures in bachelor's or in master's about the statistics, so your statistics mentor will always give you the data, that this is the data, calculate the mean, calculate the standard deviation. So here, keeping the concept of the data, you will play with it. The data will be from the market, and the data will be previous data, like for last 10 years data. The data can be of any type of industry, and you can easily calculate the mean and standard deviation of it. Like before this, only you studied for the papers, and you just came and you did sigma x or sigma fx divided by n and blah blah blah, and you got the results, and there was no interpretation of the results. But now you are the scholars. Know what you will do, you will select different type of sectors like oil and gas sector, agriculture sector, cement industry, and then you will take 10 different companies from there. Then you will take the data of that company's data of what? Data about their investments in different stocks. So when you will get this data, and if I ask you to calculate the arithmetic mean of it, so you can easily calculate the arithmetic mean of this. So what basically this means, that the data is very much important, because this chapter decisions will be made on the previous data. The previous data will tell you that how much risk is involved in the market. The previous data will tell you that whether this data is very much conducive, is very much juicy for getting the return, and it is very weak to get the return. On the basis of the data you will get from the market regarding different type of the organizations, different type of firms, different type of companies, you will decide on the basis of their data. Like for example, if there is a company with an example of Nestle company, and if their return is regularly like 2010 they give 11, 12 they give 15, and thus the return is increasing from time to time. What is actually this means, that with every return the organization sale will be increased. With every sale the organization production will be increased. With every production the organization's material cost will be increased. So there is a link between all these things. All the companies are the player of the market. Keep this point in mind. All the companies are the player of the market. All the players have their data. And on the basis of data, you have to measure their risk and return. then in that player you have to invest, like in IPL, like PSL, Pakistan Super League, like BPL, Bangladesh Premier League. They are doing what? They are investing in what? In different type of, this is a general example, in such a type of players who has the return ability. Why? Because there is an investments on their shirts by different organizations. Why they invest? Because they are just working for the marketing purpose. Why marketing? Because they want to increase the sales. Why sales? Because they want to increase the revenue. Why revenue? Because they want to increase the profit. Why profit? Because they want to increase the dividend for their shareholder. So keeping all these things in mind, what happens that you have to go for all the data of the market. Then by taking the data, you have to calculate the mean and standard deviations. Clear? Hello?
Yes, sir, clear.
So take a break.
Okay,
Then
sir.
I will come again. It's prayer time over here as well, so I will come again to you guys. Okay?
Okay, sir.
Thank you, sir.
Welcome, welcome.
Okay, sir. Thank you.